Okay, question is Robson company. This is actually ACC exam question, but I've taken it from Kaplan kit. I mean, this is question number 37 in Kaplan AFM Kaplan practice kit, but essentially it is a question from ACC exam. Now, why did I pick up this question? Let me first say, number one, this is a question which is for APV, which is a very important topic. Number two, we have actually done several questions on APV. You can see on your portal. Some of them, they have very long details, and sometimes I would say that unnecessary details. This particular question, we can quickly finish it. It's not really very long, but it actually involves all the possible scenarios which you might face in APV question. So I would say that it is one of the best questions to understand APV in the minimum possible time. Okay. It has like some discussion. While I will read the question, I will highlight those areas that if the information is given in this way or in that way, in this way or in that way. So all the possible options which you could face in exam for APV, all of those, they have combined them into one question. I'll start reading the question. Then before we go to the solution, we will do some discussion in between, which would be very interesting. And then we will continue reading and solving the question. So I'll just read the question so that we have some background to build up our discussion. It says that the following exhibits available on the left-hand side of the screen in the CBE exam, like in exam, the exhibits are on the left-hand side. They provide information relevant to the question. Robson company and project information, this is one exhibit, and further information on project finance, this is the second exhibit. Anyways, this is how it was presented in the exam. This information should be used to answer the question requirements within your chosen response options. So number one, this was the first exhibit actually. This is Robson company and project information. Robson company is a food manufacturer with a portfolio of well-known brands. The founding directors retain a significant minority shareholding. The founding directors, they retain a significant minority shareholding in the company and continue to serve on the board following a successful listing 10 years ago, which means that they went for an IPO and they are now a listed company 10 years ago. After obtaining the listing, the Robson company's gearing ratio increased significantly, which means that they have taken additional debt above the sector average. So whatever are the other competitors in the food manufacturing, Robson's company, their gearing or their debt ratio is bigger or is higher, as a result of a poorly timed expansion strategy, mainly financed by debt. So they tried to expand, and in order to expand, they got some additional debt, and that was probably not properly timed. Earnings became increasingly volatile. This is the first effect of debt. Whenever you take more debt, earnings, they become volatile. Why do they become volatile? Because the periods when you have less revenue or less profits, you still have to pay the interest payments on the debt, and therefore earnings they significantly change. And the debt burden triggered a decline in the company's financial performance. Financial performance means profitability. The profitability was affected because of the additional debt and the additional interest payments. And of course, interest payments, they go into profit and loss and they decrease your profitability. The board responded to these problems 5 years ago by pursuing a debt reduction turnaround strategy, which has been financed by a series of right issues and asset disposal. So what they were doing, they were selling the assets, probably the unnecessary ones, and they were returning back the debt. And secondly, they made some right issues. So when you do right issue, you are offering or issuing the equity shares. So it means that you are adding into equity and you are reducing the debt by selling the assets. So you somehow managed your gearing. Okay. Equity increased, debt reduced. So gearing ratio was under control. So this was a good move, which they did. So initially they made a mistake, seems like that, but then they tried to recover from that mistake. Now, even though This strategy successfully reduced the gearing ratio, which is now equal to the industry average, which is a good sign. The share price remains depressed due to comparative pressures within the industry. So share price has not improved. The company's credit rating has recently been downgraded once again. Once again. So, Robson Company's chief executive officer has identified an opportunity to relocate the manufacturing plant and develop a state-of-the-art automated production line, which will reduce the underlying cost base and be a source of competitive advantage. So they have some pressure from the competitors in the industry, competitive pressures within the industry, and what they're trying to do, relocate their production facility to some other place and to have this automated production line. Now, a question comes in that you can have automated production line in your existing location as well. I mean, automated production line does not depend that you cannot have automation here. Automation can only be there. So anyways, we'll see that automation is a good thing because your cost base will decrease, profits will go up, your ratios will improve, and so on. Let's read the question now, the data. It says that project information, Robson Company's finance director has prepared estimates of the free cash flow generated by the project based on a 4-year time horizon. Free cash flow, in year 0, you probably will make the investment about relocation. Then in year 1, 20.9 million, 20.6 million, 28.7 million, and in year 4, 104.6 million. This is, by the way, a big question mark, that why your cash flows are so significantly increasing in year 4. Probably you are having the terminal cash flows adding up here. Anyways, which is not a good sign. The investment cost is 120 million. So in year 0, you have 120 million going out, cash outflow, which Robson Company proposes to finance as follows. So they need $120 million for this relocation. And how to finance this 120 million? Now, this data is interesting. Disposal of existing manufacturing plant, 20 million. So you need 120 million. The question is where it is going to come from. 20 million you will receive by selling your non-current assets. 10 million you will gain by doing the right issue. Subsidized loan of 3.5% annual interest rate is 40 million. You will take a subsidized loan. And then you have a bank loan which you are going to take from, which is 50 million. So apparently it looks like that out of 120 million, 90 million is coming in form of debt. So all those efforts of decreasing the debt and improving the gearing ratio will be wiped away with this one decision. That is, I mean, in the last paragraph, we noticed that they have taken some measures to reduce the debt and improve the gearing. But this particular decision, you are actually getting 120 million, out of which 90 million is debt financing. This is subsidized loan, probably the government is giving, and they are giving it at 3.5%. That's why we call it subsidized, because based on their existing credit rating, the bank is offering them 9%. So it means that this is a company which can get debt financing at 9%. So somebody else is giving at 3.5%, which is a subsidized loan, and most probably it is by the government. Now, if it is by the government, there must be some conditions on that loan. I mean, the government does not give subsidized loan to commercial enterprises for free. They give the subsidy loan, but they have some conditions. Okay. The bank loan is repayable in equal installments over 4 years. Now, this thing is very important for calculation purposes. And that actually makes your life difficult. Whenever you see a bank loan, and you of course need to do the calculation of interest, etc. So in some cases, they do not mention how the bank loan will be returned. So if they do not mention how the bank loan is going to be returned, you assumed that it will be paid all in all in the end. But here in this case, they specifically mention that you have to pay it in equal installments. It means that if I take this 50 million loan here, I have to pay some part of the loan in the next year. I have to pay back. So it means that next year, my total outstanding amount of principal will be different. So it means that the interest payments, which I will be making in next 4 years, they will be different. So you have to create a separate table for bank loan outstanding principal amounts and their respective interest payments in every year. This is what you need to do in this case. If they don't mention this thing, that you have to pay in equal installments, I assume that I take 50 million and all of that will be returned back in year 4 or in year 5. So it means then in throughout this period, my interest payments will remain same. So life becomes easy. Calculation was easy. For example, I would say 50 million, it's my loan and I have to pay, for example, 9% interest. I will multiply like this. And for 4 years, I have to pay. So I find out the annuity factor for 4 years. I multiply with that. And then whatever is the tax rate savings, I will make separately. But essentially, I can multiply 50 million with 9%. I say this is my interest payment every year. So interest payment is fixed, 50 million into 9%, and then you have to discount it. Though life becomes easy. But when they say that you have to return it back, so then you have to create a separate table for year 1, year 2, year 3, year 4, and you have to calculate your interest payment separately because those will be different amounts. You cannot say 50 million into 9% because you are paying back the loan. So next year you probably have 30 million outstanding. Maybe next year you have 20 million outstanding and so on. So this is important. This is what I said in the beginning, that this particular question, it involves all the possible types of calculations. Okay. This is one different type of calculation which we need to make for this question. Issue cost of 2% are payable on gross external financing and are not allowed for corporation tax. Now, this is again a very important condition. So issue cost of 2% are payable on gross external financing. So what is your external financing? Your external financing is subsidized loan, for example, or probably it is the bank loan, for example. And this is payable out of the available cash reserves. How are you going to pay the issue cost? So now this is again for issue cost. There are two possibilities, and this question has created that event as well. Now, in some cases, if I need 10 million, for example, if I say, let's call this number for subsidized loan. If I need I need a loan, I need a financing of 40 million, and there is 2% of issue cost. So it means that I actually I do not have to take 40 million. I need to take more. So that is called grossed up financing. So I need net amount of 40 million. I divide it with 0.98, and that would make me 40 divided by 0.98. So it means that my financing will be, my loan amount should be 40.8 million. From here, I will say issue cost of 2%, which will be 40.8 into 0.02, that is 0.8, and then I get a net amount of 40 million. So this is one thing which you have to be careful. In most cases, they would say that there is a 2% issue cost, and they will not tell you that you have to pay it from your external reserves. So in most cases, they say issue costs are 2% payable on gross financing. That's all, for example. So then I say, okay, I need to see how much loan I have to take. See, I need $1,000 loan. The bank service cost is $50. So if I take 1,000 loan from the bank and $50 I give to the bank, I only get 950. With 950, I cannot start my project. I need 1,000. in my hand to start the project. So I go to the bank, and instead of borrowing 1,000, I borrow from the bank 1,050. And then that 50, I give it to the bank. I say, this is your service fee. Give me 1,000, and I go and I start the project. Okay. This is the idea. So usually in most cases, they will say 2% is the issue cost. Whenever they say 2% is the issue cost, your understanding is that my financing is going to increase. I don't have to borrow 40 now. I actually need to borrow 40.8 million. So that 0.8 I give to issue cost, and 40 I take and buy my machinery and start my project. This is what we usually do. In this question, you will not do this, because they say that issue cost you have to pay from your cash reserve. So it means that you will actually borrow 40 million exactly. Now, this is a unique situation. And that is why I picked up the question, because they created this unique situation of equal installment, and they created this unique situation of cash reserve. Because otherwise, in all questions, you will say, okay, I need a financing of 40%, 40 million, 2% issue cost. So it means 40 divided by 0.98, my financing is 40.8 million. And this is how we have done most questions. This question, you have to be careful. You will issue or you will take loan for 40 million only. Okay. This is the second interesting point in this question. Third one, the finance director has asked you to ignore underwriting cost relating to the right issue. So he says that this is the right issue and it has some, so 2% is my cost on external financing. Okay. 2% is the payable on gross external financing and are not allowable for corporate and are not allowed for corporation tax, which means that this whatever expense you will use 2 million, you will not get a tax benefit for that. That makes life easy. But this thing is very strange. It does not impact my calculation, but this thing actually is going to be discussed in the discursive part. Why finance director says that you can ignore underwriting cost? Underwriting costs are always there. Underwriting costs are where you have right issue. So you have to pay when you issue the shares. So you involve some financial institution for doing that right issue, and they don't provide the services for free. And it's like $10 million worth of right issue. So there might be some significant cost, maybe 2% or 1% or 3% of the total. So you cannot or you should not be ignoring it. Anyways, it does not impact the calculation. Additional information. Robson company current asset beta is 1.22. Now this is asset beta. This is not equity beta. Asset beta. Asset beta means this is the business risk. It does not include, so this 1.22 is not equity beta. It does not include the risk of the gearing impact. It is the pure asset beta. I mean, the risks which are associated with the asset of the business, which means the nature of business itself. The risk-free rate RF is 3%, and the market risk premium means RM minus RF, is 9%, which is too big. The CEO expects the business risk of the company to remain unchanged. So this is the asset beta, which means that this is the risk which is because of the nature of the business. CEO says that the risk of the company to remain unchanged. So which means that we can use this number. That's a good thing. Okay. Your risk profile is not changing. So you can continue to use your previous asset beta of 1.22. Corporation tax is payable at an annual rate of 20%. Okay, now there is some further discussion. The board discussed the financing of the project at a recent meeting. Robson Company's corporate bankers have already approved the financing of 50 million. Bank is giving 50 million bank loan, but the finance director is concerned about the following capital provider. But the finance director is concerned about the following capital directors, external shareholders, subsidized loan providers. Okay. So this is actually a discussion part. Even if you are in exam, if you want, you can read it. If you want, you can ignore it for the moment, because this information is not going to become part of your solution of part A. I mean, this is additional discussion. This is actually part B requirement. If we come down here in part A, it says that calculate the APV, adjusted present value of the investment, and recommend whether the project should be accepted or not. 13 marks, pure calculations, very easy. Part B says discuss the factors the capital providers, excluding the bank, will consider before deciding. So we will read this information for part B only. Okay. And then, of course, professional marks are there for 5. So let's start discussing what we need to do. So they ask you to calculate your APV. Okay. How do you calculate APV? For APV, you calculate your step 1 is you calculate your base case NPV. And step 2 is you calculate your financing side impact. Now, what does that mean? So base case NPV means that you take your cash flows, whatever are there, and they have been given to us, and you discount them using your cost of equity. Now, remember, when you discount you will assume that if this is the project, if this is the business, which has these cash flows of 120 million cash outflow and then 20 million, 20 million, 40 million cash inflow, we'll get the cash flows and you discount them not with WACC, not with WACC. You discount them with cost of equity. What does that mean? It means that if the project is entirely funded by the shareholder, how much will be the NPV? We call it base case NPV. Now, you understand that debt financing has some benefits. Number one, debt financing is cheap. Number two, debt financing, you get the tax shield. And number three, you can actually get the subsidized loan as well. So if I discount this particular project with WACC, let's assume for a moment. Now, this is very interesting and very important discussion from technical point of view or conceptual point of view. If I take these cash flows and I discount them with my WACC, probably I get a positive NPV. Possibly I get a positive NPV and I say, oh, let's do the project. Now, why did you get this positive NPV? Because within the WACC, you had cost of equity and cost of debt, and cost of debt has got a lot of benefits, okay? Because it reduced your WACC, tax benefits, subsidy benefits, and so on. So you say, project is giving me NPV positive. Now, remember that when I say that, okay, NPV is positive, is it that the business is very good? Or is it that the financing made it look good? These are two different things. One is that the business idea itself is very good. Second is business idea itself might not be very good, but because you have very cheap financing, that makes it look good. So I want to see them separately. What is the impact of the business idea itself if I finance it with my own money and not taking any debt? And then I say, okay, let's see what is the financing side impact. So when you calculate base case NPV, in most cases, you will get a negative NPV here. Because this is the purpose of this type of questions. So you will get a negative NPV. Maybe you get a negative 5 million. You say, oh, because cost of equity is higher and you are discounting it at a higher discount rate, so you will get a negative NPV and you will say that this particular business, if I only finance with my own money, it might not look very attractive. But then I say, okay, let's add some debt inside. And when I keep on adding the debt inside, I start getting the benefits, the benefit on the tax shield, the benefit on the subsidized loan, and so on. And I say, what is the financing side impact? Financing side impact is 9 million. And now you say, okay, plus 9 million, the benefits from financing, minus 5 million is my base case NPV, my NPV final comes out to be 4 million. Okay. So 4 million. It's 4 million positive. If you have done it with WACC, it would have given you 4 million here straight away. But you would not understand that why this or where this 4 million come from. Okay. So I wanted to see it separately, that how much the project itself worthwhile and what is the impact of the financing. And later on, for example, in this particular case, I thought that I will take 50 million loan from the bank and I will take 20-30 million subsidy from the government. I will take all the benefits. It gives me 4 million. I'm doing the project, for example. Now, the project looks good, 4 million. If I have done only this part, without the APV thing, only NPV, the project gave me 4 million positive NPV. Let's do it. That's a good project. It is giving 4 million positive NPV. I didn't know that what is the impact of the project itself and what is the impact of the financing on this particular project. If I only knew, if I had gone through this APV exercise and I found out that the project itself is 5 million negative, it is going into positive because of the financing. So tomorrow, if the bank says, I'm not giving you money, or maybe the government says, we are not providing you subsidized loan, I say, I'm not doing the project. The only reason for doing this project is the financing size benefit. Otherwise, the project itself is giving 5 million negative. Any benefit which you see in here is actually not the result of the operational activities of the business. It is actually the result of this thing, the financing side benefit. So when you calculate APV, you are actually breaking down your NPV into two parts, and you are seeing that what is the contribution towards shareholder wealth maximization as a result of the operational activities of the project, and what is the impact on the shareholder wealth maximization as a result of financing options which you have. This is why we calculate APV. Okay. Because project itself, if I see here, the project itself is 5 million negative. It does not have any operational feasibility. I mean, if it is come out to be like that. So then I say, okay, then I understand that financing is important. So I don't want to do this project with my own money. I will only run this project if I get these financing options. This is the concept of APV. Now we need to do the calculations. Calculations are rather very simple. Let me just put here. Let's put like this. Year one, okay, no, year zero. Year 1, 2, 3, 4. Okay, what do I have? I've got my investment, which is in year zero, which is minus 120 million. Then I've got a positive cash flow of 20.9 million. So they made your life easy. You don't have to calculate revenue and variable cost and fixed cost. They already have given you your cash flows straight away. 104.6 million. What you need to do, you need to have here your discount rate. Okay, discount rate. And that discount rate should be cost of equity. You can put here title that what you are going to calculate, you are calculating base case NPV. Okay, so you are calculating base case NPV. For base case NPV, you need cost of equity. How do you calculate cost of equity? I've got the formula. My RF is risk-free rate is 3%, 1.222, 3%. My beta is 1.222, and market risk premium. Market risk premium means RM minus RF is 9%. And the question says that the question told us here that the risk remain unchanged, which means that this beta will not change. I can use this beta to calculate using my CAPM. I will use my CAPM to calculate cost of equity. The formula for that is actually RF plus beta multiplied by RM minus RF. So this RM minus RF is risk-free, is market risk premium. 9% is not RM. 9% is already RM minus RF. RM actually is 12%. Market return is 12%. When they say market risk premium, it means that you have already calculated RM minus RF. So how do I calculate my cost of equity? It is 3% plus beta into this one. That makes me 13.9992999, which is 14% approximately. Okay. So my cost of equity is 14%. Let me just write down here with hand 14%. I removed the formula and I put it 14%. Now, if I have 14%, my discount rate, how will I calculate? Discount rate will be 1 divided by 1 plus this cost of equity, and I'll take power 1. Power this one, okay? And then this cell, which is M22, I will put F4 so that I can put the dollar signs, and I'm locking this sign. I lock this this one, 14%. And then if I don't lock, if I do not lock it, what will happen? I want to, calculate this formula. Everything will be like this, because what is happening when you are here, it says this one, but when you come there, it will keep on moving your cell. So I want to lock this cell. So that's why I take my cursor, I put F4, it locks the cell, and then I take the discount factors. And here I say my present value. So the present value will be this one. And then I say my NPV. NPV is going to be the sum of all of these ones. And that's done. And let me call it base case NPV. Okay, base case NPV is minus 4.5 million. Like I told you that in most exam questions, when you are asked to do APV calculation, base case NPV will be usually negative, because this is where you start the discussion. Now, what I understand with base case NPV, okay? So remember, base case NPV, how do you calculate? You discount it with cost of equity. You don't discount it with WACC. You say, I don't want to see the impact of debt financing. I only want to see the impact of equity financing. So if this is the project which is giving these cash flows, and if I use the shareholders' money, and the shareholder money is costing me 14%, at 14%, the project is 4.51. So if the bank or the government or anyone else, they refuse to pay me money, I cannot, or I will not do the project with my own money, because at 14%, 4.51 million is the negative NPV, which means that if you finance this project with shareholders' money, you are going to decrease shareholder wealth with 4.51 million. And of course, you don't want to decrease shareholder wealth. You say, I'm not doing it. But then you say, wait a minute, I have some financing options. Okay? Financing side impact. I'm going to get financing side impact. What are the financing? If I go and I go for financing, what impact will it have? Or how much benefit will I get from that? So before you go for that, you have issue cost. This is a negative thing. This is not a benefit. So financing side impact has some benefits and some cost. First is the issue cost you have to pay, and that is how much they have given us in the question, I think. Issue costs are 2%. 2%. Issue cost of 2%, which are payable in which are payable from cash reserves. So issue cost, right issue, subsidized loan, bank loan, 100 million. Issue cost of 2% are payable on gross external financing. So gross external financing, this is your internal financing. You are selling, all other is your external financing. So 2% of 100 million, it means that 2 million. So this is -2. I have to pay -2 straight away. Then what will I get? I'll get tax shield. You can call it tax benefit, tax shield on subsidized loan. Then you get tax shield on bank loan, and then you call it subsidy benefit. Now, what is the three types you will have usually? Tax shield on subsidy loan. What does that mean? You see, you are actually, subsidy loan has two benefits. This subsidy loan, I have two benefits. First benefit is the saving on the tax, and second is the saving on the interest. Because remember, when you pay this interest amount of 3.5%, you make a tax saving on that, right? You make a tax saving on that. This is this one. But then you have a subsidy benefit as well, because the market rate for you, for a company like you, is 9%, but you are only paying 3.5%. So the difference between 9 and 3.5, that is also a benefit. And tax shield on bank loan is this one. I'll pay 50 million to the bank, and then I have to pay interest on that. And then on that interest, I will take the annuity factor benefit to find out the present value. All of these have to be calculated. So by the way, some of them will be one time, like this is one time. And some of these will be throughout the project. For example, this tax shield on subsidized loan, it's throughout the year, because in year 1, year 2, year 3, year 4, you will pay the interest, okay? And on that interest, you get the tax benefit, because every time you pay interest, you take it to your P&L and you get the tax shield. So this benefit occurs in 4 years. So then we have to find out their present values so that we can find out one number here. So we multiply it with the annuity factor. You can do it individually or you can do it there as well. This is okay. So you have to discount them. Now, a very big question arises here. The question is big and the question is important, and therefore let me make a bigger question mark. A very big question arises here, that when you have to discount these benefits, what should be your discount rate? What should be your discount rate? So you have got three types of discount rates here. One discount rate is risk-free rate. Three rates you have, which is 3%. The second option is your cost of debt, which is 9%. These are the things which we have been given in the question. And the third one is my cost of equity, which is 14%. These are the three possible rates. Remember, in base case NPV, we use this one. We discounted the cash flow with 14% base case NPV. The cash flows on the top. Let me show you this one. We are doing it actually at 14%. This discount factors are 14%. Okay. Now, when you will calculate this subsidy benefits and others, which discount rate you will use? Answer here is that you will never use the cost of equity. That is for sure. You have a choice of using either the risk-free rate or the cost of debt. You can choose either this one or this one. I would recommend using the cost of debt. Even if you use the risk-free rate, you still will get marks in the exam. If you go and see solutions on BPP book or Kaplan book or ACCA Hub, sometimes they use 3%. and they say maybe you use 9%, no problem. Sometimes they use 9% and they say maybe use 3%, no problem. So you will find in all of these kit questions, whether BPP or Kaplan or ACCA Hub, so maybe they give you solution with RF and they say KD is also acceptable. Or maybe they give you solution with KD and they say RF is also acceptable. But if you ask me, I would suggest you to always use this one, KD. Don't use risk-free rate. Risk-free rate is for risk-free investment. You are investing money in the business. That's not risk-free. So the cash flows or the benefits which you are getting there, they are not risk-free. So you have to use a discount rate which is appropriate for a business like you and which has been accepted or established by the market. The market is rating you, the market is rating your company to have a capacity to borrow funds at 9%. So they are actually incorporating your risks at 9%. So this is what you should be doing. So we need to do some discounting here, and the discount factor will be 9%. Okay. Okay, somebody asked that why we are not choosing KE. We said we had three RF, KD, and KE. And I said we are not choosing KE because KE is cost of equity, which is the expected rate of return by the shareholders who are taking all those risks which are associated with the equity ownership. They are not equity ownership because banks still you have to pay the interest. So bank is not taking that risk. Sometimes banks, they are giving you a loan at 9%, they are taking the collateral. So there is no case of collateral with cost of equity. There is no promise for dividend with the cost of equity. Cost of equity is 14%. It is more because they don't have any security on their interest or their earnings or their actual amount. But this one, they do have a fixed 9% return, so that risk is gone. And they do have sometimes collateral as well. So the return of the money is also gone. So, I mean, these are two different things. If I take a loan, I mean, how can I discount the debt with the cost of equity? These are two different perspectives. So in this case, because it is a debt, and these are the benefits which are related to debt, and therefore we should be taking the cost of debt. Okay. I hope it makes sense. Okay, if we have to calculate the tax shield on subsidized loan, actually, I can calculate this thing very easily. It's very straightforward, and you should be doing it very straightforward, very quick in the exam. But just for the sake of discussion or for the sake of explanation, we will make it, we'll start from the very basics so that, I mean, some of you people probably would understand one line calculation, but let me explain you the logic where it is coming from. So you are taking a subsidized loan of 40 million, right? So you are taking 40 million loan and you don't have to return it during the year because the equal installment loan was bank loan. The bank loan is repayable in equal installment. But this subsidized loan they did not mention. So we assume that we have to pay it in the end. So we say that from year 1, 2, 3, 4, our loan liability is 40 million and you have got 3.5% interest on that. So it means that every year you will pay this amount of interest, right? 1.4 million interest. So when you pay this interest, and this actually continues for all 4 years, and then because you are paying interest, you get the tax benefit. The tax benefit is 20% of that. Remember? Because you will take 1.4 million into your income statement as expense and your profit will decrease and your tax liability will decrease. So you get 20% benefit on that. So let me just put it F4. And this is the tax benefit every year. Now remember, the interest amount remains same. And the tax benefit remains same. Why this is happening? Why it is same? Because your loan liability remains same throughout the period. Your loan liability is not changing because you are not returning back the loan. For the bank, this interest amount will change because every time you will pay back. So this is I'm doing for subsidized loan. the government loan. So this is the benefit which you are getting. And you get this benefit in year 1, in year 2, in year 3, and year 4. And then you have to discount it down. And we said that we will discount it at 9%. So we'll use 9%, which is cost of debt. And I have to discount it. So I use the discount table, the discount factors. 1 divided by 1 plus this 9%. And I'll take this power 1, okay? And this 9% thing, I will lock here with F4, and then I copy paste it, okay? So this is 0.917, and these are, I'm calculating the discount factors. Now, this is the tax benefit, and this is the present value. So it comes as the PV, okay? So what I'm doing, I'm calculating so I get a benefit of 2.4 million. Let me just take this one here. I get a benefit, a tax benefit. This is my tax benefit, okay? 20% is my benefit. And this is the present value of benefit, PV of benefit. So with 1 year factor, with the second year factor, this one, present value factor. So this is the total benefit I will receive in 4 years' time. So if I make a sum total of these 4 values, I get 0.91. So my total benefit from the tax shield on subsidiary loan is 0.91. This is the number. Now, this is a long calculation. Can we do it in a short way? Yes, we can do it in a short way. What could be the short method? The short method would be 40 million is my loan multiplied by 3.5% interest I will pay. This same 3.5% multiplied by 20% is my tax saving multiplied by annuity factor of 9% at 4 years. Can I calculate that annuity factor? Yes, I will. In exam, you will take the numbers. Here, I'm calculating it manually. Okay. So how do I calculate? Let me just take these numbers down. I'll take my annuity factor. In exam, you will be using your table, but I will calculate manually here. How do I do that? 1 divided by 1 plus this 9%. And I would say power 1. This is my first year factor. This number R51 I will lock. And these are my 4-year factors. The same 4-year factors which I wrote above, I calculated them again. And how do I get annuities? Annuity is actually like you are adding up for all the years. So my 4-year factor comes out to be this one. 3.24. This is my annuity factor, 3.24. So it means that I have to multiply it with 3.24. Now, if I put an equals to sign here, it gives me the same number, 0.97. So instead of doing this entire long calculation and doing it one by one, which is definitely nobody will do, I only made this table. Let me take this table away from your eyes. I don't want you people even to see it. I just put it here to explain you the logic. What you will be doing in exam, you will put here the formula like this. You will show that number here without equals to sign. Okay, so this is how I calculated it. Then you come down to the tax shield for the bank loan, then you come to the subsidy benefit and so on. So I need one number, this is done. I need the second number, this is done. Now I need the third number, which is the tax shield on bank loan, and then I need subsidy benefit. Okay, now bank loan I have to create again. Bank loan. How much is your bank loan? Your bank loan is 50 million. And you have to pay it back in equal installments. Bank loan, you have to pay it back in equal installments. So bank loan, because bank loan I'm returning back, so it means that the interest amount, here when I make it, my interest amount was same. Because I assume that I'm not returning back the money. But in case of my bank loan working, in case of my bank loan working, where should I put it? Let me just take this thing up somewhere and I'll call it my bank loan workings. By the way, this working you have to show in exam. This working is not needed. I just made it for myself for explanation, but bank loan calculation, you will present it in exam. Okay. Bank loan working, you should present it in exam. And therefore I should actually take it here somewhere. I have to show this working. This one I just made for calculation of my present value or something. So bank loan in year 1, in year 2, in year 3, and in year 4. Equal installments. Now, this is one topic which you go back to ACCA FM or F9 and you learned it there. How do you calculate equal installments? So if I have my opening liability of 50 million and I will pay my interest at 9%, which means that it is going to be 50 million times 9%. And then I have to, so this is my initial liability. This is my interest payment. This is interest, not payment, interest expense. And this is my payment of installment to the bank. How much should I pay? Equal installment. How do you divide? How do you find out 4 equal installments? The rule there was that you take your initial amount, which is 50 million, and you divide it with the annuity factor. Which annuity factor? 9% annuity factor for 4 years, which means that 50 divided by 3.24. So if because I think we calculated 3.24. Yeah, 3.24. So what I will say that my installment will be 50 million divided by 3.24 and I multiply it with 1 so that it comes out into negative. So it means that every year I have to pay 15.43. So my liability end of the year 1 is 39. And this one also I need like this. I'll make it underline. This becomes my opening liability for year 2. And then I will have my interest payment on this one, which is like this, and equal installment of this, and now this. Then in the 3rd year, it will be like this, multiply this with 9%. And why I'm making this table? Because you see your interest payments are changing. And I'm just showing you that are you going to close this loan with this amount or not? It's almost closed. So it means that our equal installment calculation is correct because you have almost closed your loan amount. There is a very little difference, and that is the difference as a result of rounding. Now, what do we understand here? So you get benefit. Now, this table I made, why did I make this table? I only made this table to find out my interest payment, which I'm making every year, because I get benefit on this line. So I needed this number actually. I prepared this table to calculate this number. Now, if you see, your interest payments are different. When you were doing subsidized loan, you said interest payments were same. You see, interest payments were equal, 3.5%, because your principal amount was not changing. So this question, when I said that it is a good opportunity to learn, because subsidized loan interest calculation is very straightforward, but the bank loan interest payment calculation was different because you were returning back the loan. Now I will calculate my tax shield. Tax shield on interest, on bank interest, on bank loan interest. So how do I calculate that tax shield is 20%. 20% of what? 20% of what? 20% of this amount into 0 point, right? So this is the tax shield which you are getting. And then you have to find out the discount factors. So what are the discount factors? Let me just take this one. Or Because I calculated them above, so 9%, I will use this thing, 9% discount factors. So you can take it from the book or wherever we have already calculated this thing and the present value. So the present value of this is the tax benefit and this is the present value. I multiply and then I say sum of present values. So these are the four present values. Okay. I hope you guys understand bank loan calculation. How did I do that? And I think that I did not make a mistake. I also hope so. 1.98. So this is the sum of present value. What I did, I said that I have to pay interest and the bank interest is not going to be same every year. So let's calculate interest. So I calculated the interest by paying back the loans and paying interest only on the remaining amount. Then these interest, I multiply them with the 20%, I get the tax benefit. And then this tax benefit, I found out the present values. And then I added up those present values. It comes out to be 1.98. So tax shield on bank loan is 1.98. This is the number. Now, it might be slightly different if you see the solution on ACCA Hub or in the practice kit. It might be slightly different because I calculated discount rate using the formulas, and you take the book or the ACCA Hub, they use discount rates given there. You see, when I calculate discount rates, they are like in Excel formula. So they are continuing with 7-10 decimal places. And therefore, the difference can arise, okay? Because we are calculating, when you use it from the book, there are only 3 decimal places. Here, there are 10 decimal places. By the way, these are more accurate. But anyways, so this is done. So we have got the third number as well. Now, let me just take it down a little bit so that we have a clearer screen. The last calculation which I need to do is the subsidy benefit. How much is the subsidy benefit which you are getting? So subsidy benefit will be calculated like this, that how much loan you are taking subsidized. Your subsidized loan is 40 million and you are making a saving on the interest payment. Market rate is 9%, but the government is offering you at 3.5%. So this is your benefit, 40 million into 9% minus 3.5%. You can call it 40 million into 5.5%. So that's your saving on interest. But all of that is now that's a benefit. So all of that is your saving? No, because 20% is the tax there. So your real savings are 80%. Your real savings on interest payments are 80%. I don't have to, because here I was multiplying with 20, I was calculating tax shield. Here I'm calculating the benefit, so I multiply with 80%. That what benefit do I get? So if I save $100 on interest, does this 100 come to my pocket? No, because I make a saving, I make a profit, I make a gain, 20 goes to the government, 80 remains with me. So I have to multiply it with 80%. And then that 80% comes every year because that was subsidy loan. Subsidy loan was not paid throughout the equal installment. It was paid every year. So the benefit also comes same every year. So I multiplied with the 3-year factor, which was 3.24. So this is my subsidy benefit, okay? I take this number, I put it up here, and I make equals to sign, which is 5.7. This is the real benefit, actually, what you are making. 5.67 million, because you are paying less interest. So 4 things were there, 1, 2, 3, and 4. And now when I calculate the total of them, so it makes me 6.59, which is almost 6.6. So I call it financing side benefit, okay? So my financing side benefit is 6.59. So what does that mean? It meant that the project, if I start the project with my own money, the project has a 4.5951 million negative NPV. But because I'm going to do some financing and the benefit of financing itself is 6.59, and I say project NPV. So project NPV will be 6.59 minus 4.51 plus, because there was a negative sign there. So it's 2.08 million. We say, oh, let's do the project. But you understand so far that although you are doing the project, but the project is not increasing the shareholder wealth because of its fantastic nature. Project itself is not really fantastic in nature. The debt financing makes it makes it fantastic. All of that NPV, which is very little, 2 million you are seeing, it is not because the project itself is wonderful. This is because your financing is wonderful. Okay. Now, this is the reason for calculating your, by the way, this is not this is APV, adjusted present value. Okay. Adjusted present value, which means that as a result of this thing. Now, this is the end of the calculation. We calculated here what we learned here, that discount rate for subsidy benefits, you are going to use the bank rate, the cost of debt. You learned that if you have to return back the financing in equal installments, or I mean, the bank, I made this calculation for bank financing here, the bank financing, because I had to return back money. If I did not have to return back money in 5 equal installments, you know how much I would have done? I would have said that 50 million here, this would be a one line calculation. 50 million loan multiplied by 9% interest, multiplied by 20% the tax, multiplied by the annuity factor of 3.24. That's all. This was the working required here, just like we did it for subsidy. You see, for subsidy, we just made one single line. For subsidy here, this one, sorry, this one. This subsidy benefit was very simple. 40 million into interest, whatever, into this one. Because it was not returned back during the life. Bank loan was returned back during the life. So therefore, we need to calculate this. And by the way, I should write down here working two, whatever you may call it, working one, working two, whatever. Okay. So APV is done, 2.08 million. I hope you understand the calculation side of that. Now it says in part B, which is a 7 marks part, it says discuss the factors of the capital providers, excluding the bank, will consider before deciding whether or not to approve the funding decision. So whether or not approve the funding decision, where are you getting the funding decision? Okay, for this particular theory part B, which is for 7 marks, they ask you discuss the factors the capital providers will consider before deciding whether or not to approve the funding decision, excluding the bank. So if I exclude the bank, I've got capital providers for, external shareholders. I've got my existing shareholders. And actually, not external, it should be only existing, because we are not, if we are doing IPO, we are doing right issue. So let me see that which are the capital providers here. The capital providers, excluding bank, are this one, right issue and the subsidized loan. So it means that these are the existing shareholders. This is about the government. So what are the factors they would consider before they do this funding? So if I speak about the right issue, so of 10 million, so number one factor you can write down, because they told you that they already have gone through a recent right issue recently. So when you did, a year ago, and then you are coming back again to the shareholders and you say, please buy further shares and give 10 million. So number one, maybe they might not have this money to provide financing. Even if they don't buy the right themselves, buy the shares themselves, and they sell shares to someone else, and you say, okay, you guys provide the funding. You say, we don't have money. I say, okay, if you don't buy, I will sell it to someone else. And if someone else will come in, your voting rights will go down. So this is the first instance that existing shareholders, they might be skeptical that we don't have money, and as a result you are bringing someone else from outside that would dilute my voting right. Okay, so this is first concern. Second concern is that even if I give you 10 million, you still are going out to get 90 million of debt. And we had some struggles with the gearing ratio. We hardly were able to recover that from that, you know, area of volatility in earnings. When you bring down or bring out this 90 million debt again, what is going to happen with the gearing ratio and the volatility in earnings and the risks which are associated, and the KE, which you say is not going to change because they said that the business risk does not change. How it does not change? You are adding a significant amount of debt into the business. So this risk will change, beta will go up, and my KE will be not 14%. I'm looking at 16% now. So shareholders will be skeptical on that because they had seen a time when the company rating went down, again it has gone down, and then you are bringing in some additional debt which is going to create trouble from shareholders' point of view. From the government point of view, the government now, number one, your credit rating is down. So I'm not sure if the government will be happy to give you or not. And actually, to answer this question, you need to read this part as well. Subsidized loan providers. I will give you the solution. You can read it. We are almost about to finish. I'll give you the correct solution so that you can read it. But just one thing which came to my mind, and I want to discuss because that's very important. Because remember what they are planning to do. They are planning to do what they are saying that we are doing it because we want to move it to some other location. And to that location, it was automation plant. We want to do automated production line. So you want to do automation. Now, why the government is giving you this cheap loan, subsidy loan? Because what government is looking at is the job creation. These two things do not match with each other. Automation plants do not create a lot of jobs. So it is also possible that when you go to government and say, this is the project, and they probably would not be giving this financing. They rather would say that, okay, if we give 40 million financing, you will create only 500 jobs because you are going for automation plant, and we probably could give 40 million to someone else who can create 5,000 jobs for the same amount of capital. So this thing which immediately got my attention, that the business objective for this thing is different as compared to the subsidized loan. Anyways, solution I will provide on sheet number 2. I will upload it on, in any case, solution you have to read, okay? And you will also be able to match these my calculations. I will put the solution on sheet number 2, and I will upload this with the video lecture. But these are the factors. The government has so shareholders, they have a reason to consider. Government will consider, number one, the suitability of this investment. Number two, the job creation, which is their main objective. This is where you have to focus on. Anything you want to ask, please ask.